Hello and welcome to the June RCA Institute webinar and discussion. Right now, I have everyone on mute, I believe, and after I give the presentation, I will unmute everybody so that you can engage in any discussion or questions to the information presented. You're also free to use the chat box for questions, but I won't be able to see those while I'm presenting. I'm Larry White, Executive Director of the RCA Institute, and today we're discussing, of course, software options for resource consumption accounting. Before I begin, I just want to be clear, RCA is a modeling approach, not in and of itself a software solution. What doing RCA requires generally is a knowledgeable implementer and practitioner of resource consumption accounting and a capable software. Like I say, if you have any questions, use the chat feature or hold them till the end. So I always show this slide at the beginning of presentations just so you know where RCA fits. If you haven't been to one of these presentations before, RCA draws most of its, or a great deal of its logic from German management accounting methods known as GPK or Grenzplan Kosten Rechnen. They've been in use since the 1940s and remain in active use today. They focus on capacity analysis and management, marginal costing, things like that. RCA also brings in some of the process advantages of activity-based costing. The focus of RCA is on internal management decision-making, not on financial reporting. Its primary use is to link operations to finance, again, for decision-making, and it maintains clear cause and effect relationships. So there's no distortion from allocations or use of unusual depreciations that are easy to justify for financial reporting but don't represent reality. This slide shows where RCA fits in the continuum. This diagram, at least the number parts, not the more colorful parts, was put together for the International Federation of Accountants, Professional Accountants and Business Committee. They did a document called the Costing Continuum Levels of Maturity. RCA was judged as the most sophisticated approach to costing. You can see it starts with very traditional standard costing, goes through a series of different types of activity-based costing, finishes with RCA, and then goes on to show that the ultimate is full real-time simulation. I would argue strongly that if you're going to do full real-time simulation, you're going to need RCA techniques. And in fact, there are some now some case studies where RCA is being used in real-time or very near real-time financial information, tightly integrated with Industry 4.0 and industry digitization for manufacturing. So just again, before we start talking about software, RCA is fundamentally a modeling process. While there's a lot to it, I like to break it down into three primary steps. The first step, with a lot of sub-steps, is to identify the resources and kind of categorize them and organize them in a manner that starts to make sense in terms of your organization's processes. The second step is to identify the resource relationships. And what you're doing is you're mapping the cause and effect relationships. You're mapping the flow of resources between various resource pools to eventually final managerial objectives. Now, after steps 1 and 2, if you look at those descriptions carefully, you will find the word money or dollars is not used in steps 1 and 2. That's because you're focused on modeling operational quantities and the flow of resources. That's why RCA is very reflective of operational activities. In step 3 is where you apply costs to the model. And the idea is that you create costs that are highly reflective of those operational resource flows. So that means in many cases you're going to have to adapt your costing methodology to provide information that may not be provided today. And most certainly you'll need to adapt it to provide it if you want to achieve real-time information or close to real-time. You're going to have to adapt it in a way that provides it much faster and more consistently than often happens in today's models. The second thing is just implementing RCA. Now, this diagram is not that unique to RCA. For those of you who do software implementations, you could say this applies to almost any software implementation, and I would mostly agree with you. However, the two areas that are significant and is this idea of a conceptual design in RCA. It's very important when you do resource consumption accounting for managerial costs to design what it is you need. Because most costing softwares, most costing approaches don't start out this way. They kind of adapt what's in your general ledger to fit your situation in a way that's a little bit better than it did before. So once you have your conceptual design, then you have to realize it. And realization is really about selecting and designing or modifying or adapting your software solution so that you can see your conceptual design in it. So let's talk about software solution options. The first, as you can see, there's 3 options: large ERP, best of breed, and business intelligence that I'm going to talk about. The large ERPs have certain advantages. The advantage is that integration should be tight. Now, the software that was designed in Germany, SAP, was also designed around doing and applying German management accounting logic. So SAP can differentiate costing methods for internal use and financial reporting and maintain a reconciliation of the differences if it's set up that way. SAP is fully RCA capable, but I should mention, this is a big but, in particular, SAP United States doesn't directly support RCA. If you beat them up and asked for it, they will probably refer you to specialized consultants for that area. The software NavVision was also developed in Germany, and there's some belief, I think it was bought by Microsoft Dynamics, but there may be some RCA capabilities still available in it. So the real advantage of large ERP is lots of capability. You can tightly integrate it. There's some issues about if you've got it, changing it to do RCA. It can be done. It's going to take some rework, because as people that have done in particular SAP know, it's not the most flexible software in the world after it's set up. The second category is best of breed or specialized types of software. The best example I have of that for RCA is max controlling. The advantage of this category as a software is that they focus on specific areas. They also focus on integrating with ERPs as smoothly and seamlessly as possible. In the case of max controlling, which I mentioned, it is used by many companies with SAP because they value the way it operates and presents information. I also know of companies that use Max with Oracle. One other advantage of the best of breed or the specialized software is they tend to provide a very focused implementation consultants that can help you with these techniques that are not that widely known. Um, so you're not going to get the generalists, you're going to get more specialists in cost and profitability information that have experience helping other companies do this sort of thing. The third option is business intelligence software. Now, business intelligence software has many uses, and it is used for RCA. BI can range from a do-it-yourself to an implementation by a certified RCA practitioner. The advantages are cost and flexibility to implement your conceptual design your way. If you're going to do this, I really recommend ensuring a high quality of expertise in both RCA and the BI modeling. What's listed up here is a product called ProEO. It's an RCA framework done on a business intelligence software known as JDocs, and RCA member company Altavia has ProEO, which is the RCA template on that JDocs BI software. So those are your primary options for doing RCA. There have been cases where it's been done on spreadsheets, but as we know about most things in spreadsheets, that's a bit of a quagmire from a maintenance point of view, and requires a lot of work and tends to be somewhat inconsistent. So that's the presentation. What I do want to say kind of in closing, and before I stop for your questions and inquiries, is that software and financial systems often inherently define a management accounting approach, or the implementing consultants have a preferred method that they are comfortable with. When you depart from the world of cost accounting purely for financial reporting requirements, you kind of leave rules behind. And you need to know what you're doing then. And fundamentally, you're replacing those rules with principles. The principles come from the Institute of Management Accounting Conceptual Framework for Managerial Costing, and the two principles are causality and analogy for doing costing for managerial decision making. You need to represent the reality of your operations for decision making that will improve your profitability and optimize the use of your resources. Doing a conceptual design for your organization based on its strategic needs and the common decision making that's done throughout your organization is the key to defining the information for your organizational needs. So I've got quite a few participants. I'll unmute everybody and welcome any comments. If you want to be muted, go ahead and mute yourself, but I'd be happy to take any questions or comments from anyone in the audience.
Larry, can you hear me?
Yes, I can.
Hi, Larry. Good day to you. It's Wolfgang Dollar from Mac Software.
Yes, how are you, Wolfgang?
I'm very good, and yourself?
Good. Hold on just a second. I think I'm having trouble finding my my control panel. Okay, go ahead, Wolfgang.
Okay, great. Well, thanks for putting us in the right light, as you mentioned earlier about Mac Software. We do have a very flexible solution, and yes, we are more flexible than SAP. We have a flexible solution to proactive profit management, and it's ideally for manufacturing company and caters for multi-level bombs and routings. So we do, in this proactive approach, budgeting, simulations, forecasting, scenario planning, very much like your Continuum level 12. And then we determine profitability by customer and SKU at the end of the day. Then we compare those results to the actual and to see our forecast accuracy as well. Now, in order to enable us to do this proactive profitability analysis and essentially scenario planning simulations, where we change volumes, obviously it's very important that we separate between variable and fixed cost, and the RCA model is the perfect tool to give us that information. So this kind of RCA model that is